you'll see on the GP level we grew 58%, and really that is as a result of good inventory management. The GP percentage actually in June 2010 was about 7%, and now we closed the half year with an 8% GP margin level. Distribution costs decreased a bit. Mainly, there's been a bit of a market segment mix. The commercial customers don't use so much bridging, although we do still have quite a lot of challenges with distribution, but it's just been better managed, I think, thanks to Wambu and his team, and of course the subsidiaries as well. Administration and operating costs increased quite a lot. You would have seen from the commentary made by our chairman that there was a provision for bad debt made this half against our profit figures, and also we provide for various provisions that we need to. For example, the ESOP, as you well know, we do have a provision for that. The market price actually increased in this half of the year compared to last half, and the bulk of that expenditure is in that admin and operating costs. What else is in there that was significant? Oh, you know, with all the mergers and acquisition activities, there's also quite a lot of expenses that was above average that we normally do, so that pushed that percentage up a bit. So the operating profit increased by 90% based on the good margins and really good cost control that we had over our operating costs. The big area of concern for us is really in our financing costs. You can see that it really increased so much by 86% over last year, and the bulk of that is in the unrealized exchange losses. I'll go into that a bit more a bit later, but it is really a point of concern for us. And then after-tax profit increased by the 83%, a strong performance. So in dollar terms, our turnover increased by 26% from about $900 million to just over $1 billion, $1.1 billion for June 2011. So just very quickly, highlights on the key areas. As I said, volumes increased by 18%, our turnover 36%, the GP by 58%, as you saw me presenting it earlier on. EBITDA, excluding the exchange losses, increased by the 90%. Profit after tax, the 83%, and of course earnings per share, just relating it into shares per earnings ratio, 83% increase. The next two slides are really the two key factors that are real items that are things that we should really watch and affects the business quite significantly. The exchange rate, as I mentioned earlier on, you saw it actually hit our financing costs quite severely. And we operate in 8 currencies across our group, and it is really quite a challenge, especially with the dollar strengthening, and not just because the dollar is strong, but also the other international currencies. The euro affects it, the yen, and that actually affects our currencies as well, where we in the countries where we operate. And we've chosen the 3 that are really have been the most volatile and where we've seen the currencies affecting the earnings the most, which is Kenya, and we all know that that depreciated by about 10.5% over the 6 months. And Tanzania as well weakened quite significantly over the 6 months period, and Uganda. Those 3 subsidiaries, I would say, suffered great exchange losses. Then we've got the oil prices. We measure against the ad hoc prices. You can see it increased significantly over time from last year, January, and that also has a significant impact on the cost of goods. And those 2 factors really are things that we watch. This previous slide is just a summary of the 4 slides that I want to show you. If you look year on year, 2009 against 2010, the volumes actually dropped, mainly because of the trading. In 2010, we did not do as much trading activity as we did in 2009. Half year 2010 against half year 2011, you'll see the volume increased 18%, and as I mentioned, it was basically nearly across the board with quite aggressive growth in trading and exports, and also the subsidiaries and Kenya. Net sales increased as well. You'll see year on year, 2009 against 2010 increase. But the one that I want to highlight is the half year 2010 against half year 2011, increased by the 36% that we mentioned earlier on. Profit after tax, we already saw this. Full year 2009 against full year 2010, increased by 37%. And the half year 2011 against half year 2010 by the 83%, which we mentioned. Just very quickly, these slides are just going into some of the lines. The gross profit percentage, as I mentioned, 2009 we achieved 6.2% gross profit margin against 2010 of 7.6%. Year-to-date June 2010, 7.1 against now closing June 2011, 8.1%. Profit after tax margin, 2009, 1.3% against full year 2010, 1.7%. And you can see the improvements in 2011, where we closed with 2.6%. You'll see half year 2010, we actually had a stronger margin, 2%, but for the full year it dropped to 1.7%. It was actually affected by the second half performance, which was affected by costs of goods. Then very quickly, profit after tax, you can see the growth, 2009, 1.3 billion shillings against 1.8 billion for 2010. Again, and then first half 2010, 1.2 billion against first half 2011, 2.2 billion, which we closed with now. This slide shows the concern that we had with the financing costs. The blue is actually just the net interest expenses, net interest charge against net interest income. You will see that 2009 was a bit lower than 2010. But you will see in 2010 against 2011 a significant jump, almost doubled in the actual interest expense, and we've seen it across the market where interest rates are increasing, things are getting tough, inflation is high, so we can see that affecting us. But the bigger concern for us is the exchange losses. You can see where in 2009 it was sitting at just over 100 million shillings. In 2010 we closed off with exchange losses of close to 600 million. 2010 first half we had also a significant exchange loss of about 400 million shillings, and this time around we closed with really close to 800 million shillings, so it's really a big concern to us. The next slide just shows the actual figures over time, and really if you look at just the lower part of this chart, the first half exchange losses has been around about the 65% level, 60% levels, and this half has been 65%. So the first half, June 2010, where we had exchange losses of 423 million, it basically was around 60% of the total financing cost. This time around, the 842 is 65%. Second half 2010 eased a bit, the shilling strengthened, so we saw some benefit there. It's an area we really, as I said, are watching. Then very quickly, EBITDA, 2009 against 2010, 54% increase. 2011 first half against 2010 first half, 90% increase in EBITDA. The EPS, the earnings per share, is just a reflection of what we saw on the profit after tax increase, 2011 June against 2010 June, which was the 83% that we saw.